Walter opened his mailbox on a regular Tuesday, and there it was. A letter from Social Security. Nothing special about the envelope. But what was inside changed his whole year. His Medicare Part B premium had more than doubled. Not gone up a little. Doubled. And Walter hadn't changed a single thing about his health. He called me that afternoon, real confused. "Earl, I ain't been to the doctor more. I ain't switched plans. What in the world did I do to deserve this bill?" There's a letter combination in the Medicare world that strikes fear into folks the second they hear it. 3 letters. IRMAA. And almost nobody explains it till after it costs them money. IRMAA stands for Income-Related Monthly Adjustment Amount. And in plain English, it means Medicare's watching your income, and it ain't shy about charging you more if it don't like what it sees. Here's what makes it so sneaky. It don't look at this year's income, it looks back 2 years. So a smart money move you made 2 years ago can blow up your Medicare bill today, and you won't see it coming till the letter shows up. Today I'm going to show you exactly what IRMAA is, the 3 moves most likely to trigger it, what it actually costs you in real dollars, and the paperwork trick that can get it reversed. I'm Earl, and by the end of this video, you'll understand something most retirees never figure out until that letter's already sitting in their mailbox. This one's real practical, so grab a pen if you want. And do me a favor before we get going. Tap that subscribe button. I put out real retirement money talk like this every couple days. No hype, no fear, just what actually works for folks like you and Walter. All right, let's start with what IRMAA actually is and why it catches so many good, careful people completely off guard. Most folks think Medicare's got one price. You hit 65, you pay your premium, done. For a big chunk of retirees, that's true. But Medicare's got a second track running quiet in the background. If your income crosses certain lines, they tack on an extra charge on top of your regular premium. That extra charge is IRMAA. And it hits 2 things. Your Medicare Part B, the doctor visits, and your Part D, your prescription drug coverage. Now here's the part that trips folks up worse than anything else. IRMAA don't look at your income right now, today. It looks at what's called your MAGI, your Modified Adjusted Gross Income from 2 years back. 2026 premiums are based on your 2024 tax return. So you could be retired, living quiet, barely spending a thing this year, and still get hit hard because of something that happened on a tax form 2 years ago. Think about that. The government's charging you today based on a version of your life from 2 years back that might not even exist anymore. And it ain't a gentle slope either. IRMAA works in brackets, like steps on a staircase. Cross $1 over a line, and you don't pay a little more. You get bumped to the whole next tier. Folks call that the cliff effect. One extra dollar of income can cost you hundreds, sometimes thousands, extra for the year. Not because you're rich, just because you crossed a line you didn't know existed. That's exactly what happened to Walter. And I want to walk you through his story, 'cause I'd bet money at least one part of it sounds familiar. The year he retired, 2 things happened that felt completely reasonable at the time. Let's look at what actually tripped the wire. Mistake number 1, and this is the big one. Required minimum distributions, RMDs, starting up. Once you hit 73, the IRS makes you start pulling money out of your traditional 401k and IRA, whether you need it or not. That withdrawal counts as income, full stop. Even though it's just your own money coming back to you, it shows up on your tax return like a paycheck. For a lot of retirees with a healthy nest egg, that RMD alone is enough to nudge income right up to an IRMAA line, sometimes without them even noticing till the letter shows up. Mistake number 2, and this one stacked right on top for Walter. A Roth conversion, done all in one big year. Moving money from a traditional IRA into a Roth IRA is often a smart move long-term. Tax-free growth, tax-free withdrawals later. I talk about it a lot on this channel. But here's the catch nobody warns you about. The amount you convert counts as taxable income that year. Convert a big chunk all at once, and you can rocket right past an RMAA threshold. Walter did exactly that. RMD kicked in, and the same year, he converted a big slice of his IRA to a Roth all at once, trying to get ahead of future taxes. Individually, either move might have been fine. Together, in the same year, they stacked his income way past the line. And 2 years later, that letter showed up in his mailbox. Mistake number 3, less common but worth knowing. Selling something big. A house, a rental property, a chunk of stock, all in one tax year. That capital gain gets added right into your MAGI too. Sell the family home for a nice profit, and 2 years later, Medicare might be waiting with a bigger bill. Now, let's put real numbers on what this actually costs, 'cause IRMAA staying vague is exactly how it sneaks up on people. For 2026, if your income stays under the first threshold, roughly $106,000 for a single filer, you pay the standard Part B premium. Nothing extra. Cross that line, even by a little, and IRMAA kicks in. The tiers climb from there, each one adding more to both your Part B and your Part D premiums every single month. At the lower tiers, we're talking an extra $70 to $150 a month per person. That's Part B and Part D combined. Climb into the higher tiers, and that extra charge can run several $100s a month per person. For a married couple, both on Medicare, double that. Walter's situation landed him an extra $200 and change a month. For him and his wife both being on Medicare, that added up to real money over the year. And remember, this ain't a one-time fee. It's every month, for the whole year, based on a snapshot from 2 years back that might have already changed. Vibrant cartoon-style illustration of Earl actively pausing on the busy pedestrian plaza of Times Square, pointing upward toward a massive glowing electronic billboard overhead that reads, "Subscribe," in bold, crisp white letters, genuinely absorbed in the action and not looking at the camera, not posing, his expression delighted and warm. Earl is the same charismatic 58-year-old man with silver white hair swept back with volume on top and slightly darker roots, a full, neatly trimmed dark gray beard, round glasses with thick, dark brown tortoiseshell frames, large, expressive, round cartoon eyes with very prominent white sclera, and dark brown pupils, thick, dark, expressive eyebrows, a slightly square jawline and warm, peachy skin tone. He is wearing a relaxed green polo shirt, beige chino pants, and brown casual shoes, drawn with a slightly oversized head and cartoon-stylized proportions. Earl's left hand is relaxed in his trouser pocket, while his right hand is raised pointing upward toward the billboard. Earl is the large dominant figure filling about 55% of the frame, shown in a three-quarter view, with the bustling Times Square background containing towering buildings, colorful neon advertisements, and small, less detailed pedestrians kept noticeably smaller and softer to keep Earl as the clear focal point. In a clean vector cartoon style, with bold outlines, flat colors, and soft gradients, a playful, whimsical mood, warm, cinematic lighting, slight paper texture, crisp, high-detail line work, shallow depth of field on the background, not photorealistic, not 3D rendered, not anime, 16.9. Now, here's the good news. IRMAA ain't some trap you're just stuck with forever. There's real ways to plan around it, and even fight it after the fact. Let's get into the strategies. Strategy 1. Plan your Roth conversions in smaller bites, spread across several years, instead of one big gulp. Instead of converting a huge chunk in 1 year and rocketing past an IRMAA line, spread that same total conversion out over 3, 4, 5 years. Each smaller conversion keeps your income closer to the line instead of blowing past it. You still get all them Roth benefits, just without handing Medicare extra money for the privilege. Strategy 2, and this one's especially good for folks who give to charity anyway. The Qualified Charitable Distribution, or QCD. Once you're 70 and a half, you can send money straight from your IRA to a qualified charity, and it counts toward your RMD, but it does not count as income on your tax return. If you're already given to your church, a local charity, anywhere you care about, routine that gift through a QCD can lower your MAGI and keep you further from an IRMAA line, while doing good you were gonna do anyway. Strategy 3. Time your big one-time sales carefully. If you're planning to sell a house, a rental, or a big chunk of stock, think hard about which year that gain lands in. Sometimes spreading a sale across 2 tax years or timing it around a lower income year can keep that gain from stacking on top of your RMD and shoving you into a higher IRMAA tier. Strategy 4. The quiet one almost nobody uses. Start planning in the years before 73, while you've still got control over your income. Remember that window between stopping full-time work and RMDs kicking in? That's prime time to manage your income on purpose. Small, planned Roth conversions in those low-income years can shrink your future RMDs, which shrinks your future income, which keeps you further away from IRMAA lines down the road. Now, what if the damage is already done? What if you're like Walter, and that letter already showed up? There's one more move you need to know about, and it might be the most important one in this whole video. It's called Form SSA-44, and it's the appeal process almost nobody knows exists. Remember, IRMAA looks at your income from 2 years ago, but Social Security knows life doesn't always match a 2-year-old tax return, so they built in an exception. If you've had what they call a life-changing event, you can file Form SSA-44 and ask them to base your premium on a more recent year instead of the old one. And life-changing event covers more situations than most folks realize. Let me run through the big ones. Retirement or reduction in work hours. If your income dropped because you stopped working or cut back, that counts. Death of a spouse. Losing a spouse changes your whole financial picture, and Social Security recognizes that. Divorce or annulment. Marriage or remarriage. Loss of pension income. Even a settlement from a lawsuit affecting your income can qualify in certain cases. Walter's case fit perfectly. He'd fully retired the same year that inflated income hit. His current income right now was way lower than what that old tax return showed. We helped him fill out that SSA-44 form, attach his updated income info, and submit it to Social Security. A few weeks later, his premium got recalculated, based on his real, current, retired income instead of that inflated 2-year-old snapshot. His monthly bill dropped back down close to standard. Money he'd have been overpaying for a full year, back in his pocket, just for filling out one form most folks never even hear about. So here's the bottom line on Form SSA-44. If your income has genuinely dropped since that old tax return, for any of them life-changing reasons, you don't just have to accept the higher bill. You can ask for a recalculation. All right, jokes aside, knowing about IRMAA ahead of time is worth 10 times more than fighting it after the fact. The whole game changes once you know these thresholds exist before you make a big money move, instead of finding out after a surprise letter. So here's what I want you to actually do with this information. 5 steps, simple as I can make them. Step 1. Before you do any big financial move, a big Roth conversion, selling a property, cashing out something large, stop and ask, could this bump my income into an IRMAA bracket in 2 years? Step 2. If you're going to do a big Roth conversion, talk to a tax professional about spreading it across multiple years instead of doing it all at once. Step 3. If you give to charity anyway and you're 70 and a half or older, look into QCDs for your RMD instead of just taking the cash distribution straight. Step 4. If your income has genuinely dropped, retirement, loss of a spouse, any life-changing event, and you're paying IRMAA based on old numbers, file that SSA-44 form. Don't just accept the bill. Step 5, and this might be the most important one. Talk to a tax advisor who looks 2 years ahead, not just at this year's return. IRMAA is a 2-year echo. Planning for it means thinking 2 years ahead of where you're standing today. Let's circle back to Walter one more time, because I want you to see the full turnaround, start to finish. Walter went from confused, staring at a doubled premium he didn't understand, to fully in control of his Medicare costs within a couple months. He filed that SSA-44, got his premium recalculated down. And just as important, now he plans his Roth conversions in smaller yearly bites, watching the IRMAA lines on purpose instead of stumbling into them. He told me something I want to leave you with. He said, "Earl, I wish somebody had told me about this before I made those moves, not 2 years after. Let me give you the quick version, so you can walk away with the whole thing in your pocket. IRMAA is an extra charge on your Medicare Part B and Part D, based on your income from 2 years back. Cross a threshold, even by $1, and you get bumped a whole tier. The 3 most common triggers: RMDs starting at 73, big Roth conversions done all in 1 year, and big one-time sales like a house or property. The fixes going forward: spread your Roth conversions across years, use QCDs for charitable giving toward your RMD, time big sales carefully, and plan your income in the years before RMDs force your hand. And if it's already hit you, file Form SSA-44 if you've had a genuine life-changing event. Don't just assume the bill is final. Now, here's something I really want to know from you. And I mean this one seriously, not just for fun. Walter's mistake was making 2 smart-looking moves in the same year, without knowing they'd stack up against each other. A lot of us do that. One careful decision, then another, never realizing the 2 together create a problem neither one would have caused alone. So tell me honestly in the comments, have you ever made 2 separate money decisions, each one seeming smart on its own, that ended up costing you when they landed in the same year? What happened? I read every single one of these, and I answer. If this video helped you understand something you didn't before, do me 2 quick favors. They don't cost you a thing, and they mean a lot to me. First, hit that like button. It helps another retiree find this before their own surprise letter shows up in the mailbox. And second, if you ain't subscribed yet, come on and join us. Every couple days I break down real retirement money topics like this. Plain English. No hype, no fear. Just what actually works. Down in the comments, if you want more videos digging deeper into Medicare, RMDs, and tax planning like this, type the word threshold. Let me know you want more of it. And while you're down there, tell me this. If you could send the IRS one polite but firm message about surprise bills, what would it say? Keep it clean, folks, but have some fun with it. Now you know what it is, what triggers it, and how to fight back if it's already hit you. That's more than most retirees ever learn. I'm Earl. This has been Earl's Money Talk, where we turn the money you worked for into the retirement you deserve. Go check your own situation this week. Look at any big moves you're planning and ask if they might stack up 2 years from now. 'Cause the best time to think about IRMAA was before you made your last big money move. The second best time is right now, before you make your next one. You worked a lifetime to build this money. Don't let a quiet little 3-letter surprise eat into it without a fight. Take good care of yourself, and take good care of that Medicare premium you're paying every single month. You've got the triggers, you've got the strategies, you've got the appeal form. That's everything you need to stay ahead of this one. I'll see you in the very next one. Until then, this is Earl, reminding you it's never too late to get ahead of a bill nobody warned you about.